20% of the world's oil passes through a body of water that is, at its narrowest point, just 21 miles wide. If that bottleneck closes, energy markets don't just move, they break. This is the Strait of Hormuz, and every serious energy investor needs to understand exactly what it is, why it matters, and what happens when it gets threatened. The Strait of Hormuz sits between Oman and Iran at the mouth of the Persian Gulf. It is the only maritime exit for oil exports from Saudi Arabia, Iraq, Kuwait, the UAE, Qatar, and Bahrain. Those 6 countries combined hold roughly 40% of the world's proven oil reserves. All of it funnels through that 21-mile gap before it reaches the global market. On a normal day, roughly 17 to 21 million barrels of oil pass through the strait. That is not a rounding error. That is the difference between a functioning global economy and a crisis. Iran sits on the northern shore and has repeatedly threatened to close the strait during periods of geopolitical tension. In 1984, during the Iran-Iraq War, both sides attacked oil tankers in what became known as the Tanker War. The U.S. Navy eventually intervened to escort vessels through. In 2019, Iran seized a British tanker and attacked several others near the strait following the reimposition of U.S. sanctions. Oil prices spiked immediately. Here is what makes the strait so dangerous from a market's perspective. There is no good alternative. The 2 main bypass pipelines, the Abu Dhabi crude oil pipeline and the Saudi East-West pipeline, can together move about 8 million barrels per day. That covers less than half of normal strait volume. The rest has nowhere to go, which means any serious disruption to the Strait of Hormuz creates an immediate supply shock that no strategic reserve or backup route can fully absorb. The U.S. Strategic Petroleum Reserve holds roughly 350 million barrels. At current global consumption of 100 million barrels per day, that buys the market about 3.5 days of comfort. It is a bridge, not a solution. For energy investors, the strait is not just a geopolitical risk. It is a price floor mechanism. Every time tensions rise in the region, oil gets a bid. Every time a tanker gets seized or a drone strikes infrastructure near the Gulf, futures move. Traders who understand the geography have a structural edge over those who don't. The names to watch in this trade are the obvious ones. When Hormuz gets hot, Brent and WTI crude move first. Tanker stocks, companies like Frontline and DHT Holdings, often spike because constrained supply and rerouting demand drives up freight rates dramatically. Refiners get squeezed because their input costs jump before they can pass costs downstream. On the flip side, any prolonged disruption accelerates the case for energy diversification. U.S. shale producers become more attractive. Export terminals in the U.S. Gulf Coast gain strategic value, and the long-term argument for domestic energy build-out, including nuclear and renewables as baseload alternatives, gets stronger every time the world is reminded how much of its energy security depends on a 21-mile chokepoint controlled by one of the most volatile neighborhoods on Earth. The Strait of Hormuz is not a tail risk. It is a permanent feature of global energy markets that gets priced in and priced out depending on the news cycle. The investors who treat it as background noise are the ones who get caught off guard when it moves. This is Megawatt Markets. We break down the forces moving energy so we can stay ahead of it. Subscribe for weekly updates, and we'll see you next week.